Rohr here with an early global view on Friday, July 31st, 2015. It is currently 9:30 a.m. U.S. Central Time, so it's not quite as early as usual. In fact, quite a bit later than usual because we wanted to see the market responses to the end of month data, especially all the U.S. data that was not ultimately released until 9 o'clock. And those macro influences have been quite exciting and quite important this week. And obviously, among that, we had the FOMC on Wednesday and the U.S. first look at Q2 GDP on Thursday, along with major three-year revisions. We'll be getting back to that shortly. So, what has all this meant to the markets? Well, quite simply, on the back of those stronger than expected Chicago PMI and Michigan sentiment, we can look at the hourly chart of the S&P 500 on the left, 30-minute on the right, and see that early in the day we got a spike up to 2108.5, but the market quickly deflated back down to around 2100. Now keep in mind that 2100 is the top end of the 2096 to 2100 area we've been highlighting that has kind of a tolerance to this 2103 Fibonacci level, this violated Fibonacci support from when the market started to sense the weakness in China and other macro global news that drove it down early this week on Monday. However, by Tuesday morning, the market was already recovering because, as we know, not only don't fade the Fed, don't get too bearish of equities in front of the Fed, because all of these continued accommodation sort of statements tend to leave people wanting to own the equities. And this is exactly what we got through Tuesday and into Wednesday. And of course, after the statement at 1 p.m. on Wednesday, the market pushed up and actually closed slightly above 2100 once again. However, it dipped Thursday morning and then came back. Now here we are trying to keep the bid. And you would think on both Chicago purchasing managers and Michigan sentiment that we're a good deal stronger than expected, the market should be up. However, that employment cost index saying that basically employee pay is weaker than expected reinforces what we've seen even in the stronger employment reports of late, and reinforces what we've seen in weak wholesale sales, retail sales, etc. So this whole idea that there's a weaker background is still out there, and we're seeing how this market is hugging, since the reaction early Thursday morning, is hugging this aggressive up channel line, and even though it's leaking below it now, we'd still put the tolerance for that back down at the 2096 area. Notice all the congestion back in here around 2099 or so, this opening at 2096 and a half, etc. If it starts to break back below that later today, that'd be a pretty weak sign, where conversely, of course, the government bonds are doing very well in spite of those later figures from the U.S. on the back of that employment cost index. Now, the other thing that's important about 2096 on the short-term view is that the hourly MACD, as opposed to the 30-minute, still remains nominally out above its upper runaway band. And until this starts to sink below this upper runaway band, below 2096, we're fairly confident it will give up this upper boundary. Then it still holds the potential to push higher. Now, if it does, the higher resistance classically is at the failed up break and congestion above it, respectively at 2119 to 2125, which is exactly what we saw at the top of last week before the market faded throughout the balance of the week. And the lower support below 2096 is 2090 to 88. No surprise, we held right into that on Thursday's early weakness, and the bigger level is back down at 2078 to 75. And that pretty much does it for the short-term view of the S&P 500. A little bit extensive there because it was important to understand what's happening in the context of the background.